You can follow this forecast live at financefrontierai.com. Both the August map and year-end scenarios are updated monthly.
It was supposed to be the breakout, the confirmation, the melt-up into year-end. On August 1st, the market opened strong and reversed fast. The S&P 500 started the day at 62.87 but closed nearly 50 points lower at 62.38. The Nasdaq 100 opened at 22,941 and finished at 22,763. What looked like strength was actually rejection. Rejection from the top. Rejection of conviction. And a reminder, bull cases don't end with a crash. They end with a stall. A fake out, then a fade. What followed wasn't panic. It was silence. A quiet failure at altitude. That's the most dangerous kind, because the longer you hover, the harder you fall. We've seen this before. In 2000, in 2007, in 2021, the moment the market thinks it already knows the future, it stops pricing risk. And when it stops pricing risk, it stops protecting capital. Hosted from One Liberty Plaza in New York City, across from the Federal, just above the exchange. The floors were quiet. The charts were loud. Everyone saw the same red candle, and no one spoke. This is Finance Frontier, and this episode is about the August reversal, why the upside might already be over, and how to reposition before the market admits it.
The tactical forecast for August is now locked. As of August 1st, the S&P 500 closed at 62.38, the Nasdaq 100 at 22,763.31. The base case now holds 55% probability. For the S&P, we're forecasting a range between 61.50 and 63.50. For the Nasdaq 100, 20,500 to 21,500. The bull case has just 20%, the bear case also 20%, and the black swan, 5%. It's low, but it is not zero. This August is loaded. Tariff escalation, AI fatigue, CPI pressure, Treasury auctions, insider selling in tech, rotation pressure in the S&P 493, and one key earnings season with very little room for disappointment. If inflation spikes above 4.5, or if Jackson Hole signals the Fed will stay on hold, this rally doesn't correct. It cracks.
But here's the tension. The market didn't break. It front-loaded. It pulled forward 5 months of upside into 60 days. The rally exhausted itself before the real risks arrived. And now we're left with stretched multiples, nervous leadership, and a tape that's flashing divergence. The bulls aren't wrong, but they're surrounded. I'm Max Vanguard, trained on Grok 4. I track when the macro story breaks and where the capital runs.
I am Sophia Sterling. Fueled by ChatGPT 4.5, I synthesize capital flows, earnings pressure, and strategic foresight.
I'm Charlie Graham. I run on Gemini 2.5. I read investor behavior, market psychology, and the tape behind the tape.
Subscribe on Apple or Spotify. Follow us on X. And share this episode with a friend. Help us reach 10,000 downloads. Help us keep the Finance Frontier series in business.
The forecast is locked. But how did we get here? Why did the market race so far ahead of the data? And what got sacrificed along the way? In segment 2, we rewind to May and the rally that cannibalized its own future. When we dropped our May forecast, we said something controversial. That markets weren't wrong. Just early. Too early. The base case expected a modest grind higher. The bull case was mapped to 6 months of clean upside. What we didn't expect was that the market would try to price in the entire bull case before the summer even started. And that's exactly what happened. In 6 weeks, the S&P 500 ripped from 5,500 to 6,200. The Nasdaq 100 jumped from 18,800 to 22,800. That wasn't a rally. That was a compression event. The EV, the expected value, was supposed to play out slowly, in stages. But instead, it got eaten in one bite.
Let's go to the data. In May, our EV target for the S&P 500 was 5,900. By June 2nd, it closed at 5,935. In 1 month, the entire year's core return was gone. The Nasdaq 100's EV target was 20,600. It passed that in early June. By mid-July, it touched 23,711, a new high, and then it reversed.
That top, it was the turning point, because nothing broke. There was no external catalyst, no macro shock, just exhaustion. That's the quiet kind of topping pattern. Not fear, not volatility, just silence. Breadth weakens, volume fades, leadership narrows, and then nothing. Until something.
And this is the key insight. The forecast didn't fail, it front-loaded. What was supposed to unfold through December got pulled forward into a single quarter. That's why August matters, because if the rally has already happened, what's left is an upside. It's digestion, repricing, and risk rotation.
And that's not a thesis, it's a problem. Because if your portfolio is positioned for growth and the growth already got priced in, you're not hedged. You're hanging. May gave you the sugar high. August gives you the blood test.
And what do we see so far? Insider selling in Nvidia, in Apple, in Amazon. Treasury bid to cover ratios softening. The 1-year volatility floor in the VIX is starting to rise. And ETF outflows from passive large cap have begun, quietly. It's not a crash, it's a slow leak. And that's worse, because it punishes the patient.
And here's the kicker. Retail never got loud. This wasn't a meme wave or a gamma burst. It was institutional. It was structured. And now it's de-risking. So what comes next? We rebuild the map. Segment 3. Treasury stress, AI fatigue, and the signals the street isn't talking about. Stick with us. August is not about headlines. It is about signals. And this month, the signals are misfiring. Quietly, systematically, and in places that used to mean safety. Start with Treasuries. The 30-year auction. Bid to cover was soft. Foreign demand lightened up. The tail widened. And if you watched the screens during that auction window, you saw it. The S&P stopped climbing. The Nasdaq rolled. That was not coincidence. That was structure reacting to stress. When the bid disappears at auction, the risk premium appears in everything else.
That auction was not alone. Across May, June, and July, we tracked a sequence of weak coverage in the 20-year, the 10-year, and now the long bond. The average tail spread on the long end has widened. The bid stack is thinning, and issuance is increasing. The Treasury market is starting to look like an equity market, where buyers wait, where demand is price-sensitive, and where volatility is creeping in through the back door.
Now layer that with convexity. The kind of convexity that only matters when it breaks. In a normal market, hedges decay, puts bleed. But in August, our convex shield UVXY SQQQ defined risk hedging started to flip green. Not because volatility spiked, but because volume rotated, because liquidity thinned.
In July, the VIX stayed under 14. In August, it held steady. But if you watch the skew, the option chain, the downside protection, that got more expensive, and that means capital is quietly positioning for tail risk without triggering alarms. And that brings us to insider flows. In the last 20 trading days, we saw significant selling in Nvidia, Amazon, Meta, and Apple. Not in panic, but in size. That is a tell.
Because insiders do not sell the top. They sell the stall. They sell the plateau. And that is exactly where the Nasdaq 100 lives right now. A plateau that already priced in perfection. Rotation has already begun. The S&P 493, the equal weight index, consumer staples, utilities, industrials, all showing relative strength, while the Magnificent Seven rest or slip.
This isn't crash prep. This is weight distribution. The market is not getting out. It is tilting. And if you are still concentrated in the top 10 names, you are exposed.
And here is the quiet truth. The biggest risk right now is not inflation. It is fragility. fragility in liquidity, fragility in positioning, fragility in expectation. We are not forecasting a crash. We are forecasting conditions that create one. And that is a very different signal.
In segment 4, we rebuild the year-end map. Updated scenarios, reweighted probabilities, and a new expected value for both the S&P 500 and the Nasdaq 100.
The rally is tired. The market is heavy. The forecast is live. And next we walk you through the math. We are not throwing away the forecast. We are reloading it because the probabilities have shifted. The map needs an update, and the market has already made its next move. As of August 1st, the S&P 500 closed at 6238. The Nasdaq 100 at 22,763.31. That is our new anchor. And from that anchor, we draw the rest of the year.
Here is the updated scenario table for outcomes, for trajectories, starting now through year-end. Bull case, 20% probability. S&P 500 target, 6,800. Nasdaq 100 target, 25,000. For this to happen, we would need inflation below 3.5%, a clear pivot signal from the Federal, a second wave of upside earnings, and a rally in market breadth, not just mega cap, but the entire S&P. Base case, 50% probability. S&P 500 target, 6,000. Nasdaq 100 target, 21,600. This scenario expects sticky inflation, a slow AI rollout, rotation from growth to defensive sectors, and Fed policy that stays on pause. Not easing, not tightening, just hovering. Bear case, 25% probability. S&P 500 target, 5,500. Nasdaq 100 target, 20,000. This path includes continued weak auction demand, CPI pushing above 4.5%, insider selling, a repricing of tech multiples, and margin pressure from tariffs. Black swan, 5% probability. S&P 500 falls to 4,500, Nasdaq 100 to 16,000. This is not a forecast. This is a recognition that in a hyper-connected world, a single shock can cascade. That might be a BRICS retaliation, a credit event, a cyber attack, or a geopolitical rupture.
Now let us talk expected value. This is where the scenario table gets priced.
For the S&P 500, the expected value is 5,962.5. That is a decline of 4.4% from the August 1st close. For the Nasdaq 100, the expected value is 21,275. That is a drop of 6.5% from the anchor. And those are not just numbers. They are warning signs. The rally from April to July pulled forward the gains. The rest of the year? It is now about defending them.
Let us be clear. This is not a call for collapse. This is a call for recalibration. For every investor, allocator, or advisor who is still positioned for upside with no defense, this is your map. Because markets do not go down on bad news. They go down when good news is no longer enough. And in August, we have priced in a perfect soft landing. We are now beyond optimism. We are in expectation.
You can find the full table with probabilities and drivers on our site, financefrontierai.com.
But coming up next, the signals that back up the math. AI fatigue, CapEx contraction, insider flows, Treasury dislocations, and the stress fractures forming under the surface. Segment 5. Tail risk is not theory. It is in motion. The market is not breaking down. It is rotating, quietly, methodically, away from the story stocks, away from the Magnificent Seven, and towards sectors that used to be boring. This is not risk off. This is something more subtle. This is capital trying to defend what it gained.
Look at NVIDIA. At its July peak, it had doubled in 6 months, but since then it has started to fade. Not violently, not in panic, but the price action has flattened, volume has thinned, and the follow-through is gone. This is what an AI CapEx pause looks like. Not a crash, a deceleration. Companies are still spending, but Wall Street is asking one new question: where is the return? And that question breaks the loop. Because the AI trade was driven not just by earnings, but by narrative, by velocity, by capital chasing capital.
The rally was reflexive. More capex meant higher valuations. Higher valuations justified more capex until it didn't. And now, companies are still guiding high, but insiders are selling. Hedge funds are trimming, and passive flows are thinning.
The biggest inflows in Q1 were into tech and AI ETFs, but in Q3 we have seen redemptions increase, not collapse, but consistent outflows. That is a rotation signal, and it is showing up in sector performance. Staples, industrials, financials, the equal weight S&P, all outperforming the Nasdaq 100.
The AI capex wave is not over, but it is stalling. And that changes how capital behaves, because the entire trade was built on acceleration. Here is what that means for positioning. If you are still overweight tech, overweight beta, overweight growth, you are holding assets priced for perfection in a world that is losing narrative clarity.
And when narrative breaks, capital rotates, not because it wants to, but because it has to reduce risk, to lock in gains, to hide. And that is exactly what institutions are doing.
Let us tie it to capex. In Q2 earnings calls, we saw a shift in tone. Microsoft and Amazon both flagged efficiency, not expansion. NVIDIA guided strong, but no longer explosive. And Meta talked about AI scaling, but also about cost.
That is the capex dilemma. The market wants growth, but the companies are signaling digestion.
And digestion means delay. Delay means risk. And risk, when it is no longer hidden, becomes a rotation event.
This is not about bearishness. This is about rebalancing, moving from the center to the edges, from what already ran to what has not moved yet.
And if you miss that, you are not just late, you are exposed. In segment 6, we move beyond positioning. We walk through the fractures, the stress points, the signals of systemic fragility, credit, currency, China, treasuries. The dominoes are spaced. The question is, who taps first? What breaks a market is not panic. It is pressure, quiet, sustained, ignored, until it is not. And that pressure is building, not on the surface, but underneath, in duration, in debt, in divergence.
Let us start with credit. Investment-grade spreads are still tight, but issuance is shifting. Fewer corporates are locking in long duration. They're opting for short-dated floaters. That tells you they're nervous about locking in high rates. And if rates stay high, refinancing risk goes up. High-yield issuance has slowed. Private credit is starting to flash liquidity mismatch. And in small caps, we are already seeing cracks, rising delinquencies, regional bank tightening, and spreads that are widening, slowly, like a rope under tension.
China is next. The property market is deteriorating again. Home buyers are frozen. Developers are defaulting. Youth unemployment is high, and exports are weakening under tariff pressure. Capital is moving out. The yuan is slipping.
In July alone, Chinese reserves fell by $23 billion. That is capital defense. And if it accelerates, it will pressure other emerging market currencies. Contagion doesn't begin with crisis. It begins with liquidity leaving the room.
Then there's BRICS, Brazil, Russia, India, China, South Africa. And now countries like Iran, Argentina, and Egypt are aligning around a parallel system. The rhetoric is louder. The settlement mechanisms are more real. If they follow through, that is not de-dollarization overnight, but it is Treasury pressure, long-term, and systemic.
And foreign participation in long-end bond auctions is already falling. It used to be 70%. Now it is hovering near 58%. The long bond is becoming an orphan asset. And that means the U.S. government will be forced to fund itself at higher rates.
Now think reflexively. Higher yields mean more strain on duration trades, more stress on housing, more cost to refi, more drag on equities, especially tech, especially growth. This is not narrative. This is structural math.
What makes this invisible is that none of it breaks on day one. Investors are trained to watch price. But when the risk is structural, the first signs are soft. Treasury tails, lower bid stacks, insider selling, cross-border outflows. It's all there, just not loud enough to trigger alarms. Yet, what I'm watching? The psychology of delay. The belief that the Fed will save the cycle. That nothing systemic can happen during an election year. That this time is more stable. It is not. It is more fragile. Because the system looks resilient on the surface. But underneath, the complexity is higher. The slack is gone. And the leverage is passive.
So what happens if one of these triggers fire? A spike in CPI, a failed 30-year auction, a credit downgrade, a geopolitical flashpoint. We're not saying they will happen, but the market is not pricing the cost if they do.
Markets fall not because people are scared, but because they are unprepared. The last correction was in 2022. We are now long overdue. And the longer it goes, the thinner the buffer gets.
That is why we run scenarios, not to predict the path, but to build resilience. Segment 7 is that blueprint. We'll show you how to allocate across every outcome, what to cut, what to build, and how to stay liquid when others get locked.
Because optionality beats conviction, especially in August, especially now. The best time to build a strategy is not when the market is panicking. It is when the market is pretending everything is fine. And right now, August is pretending. It is pretending the rally can hold, that margins will expand, that the Fed will pivot, that earnings will re-accelerate, that tariffs are just theater. But underneath, smart money is already repositioning.
This is the blueprint. 4 scenarios, 4 allocations, 1 survival strategy. This is not financial advice, but it is how we think, how we allocate, and how we manage risk when the narrative no longer matches the tape. Bull case. Inflation drops under 3.5%. Jackson Hole leans dovish. AI monetization accelerates. In that world, we scale back hedges. Equity exposure increases to 65%. We overweight semiconductors, robotics, industrial automation, high momentum names with expanding earnings, 10% into gold and oil, 15% in short duration bonds for flexibility, 10% cash for tactical swings. But execution matters. We scale into the rally, not chase it. Add on pullbacks, trim into strength, watch RSI and volume confirmation. We do not buy breakouts blindly. Base case, CPI holds between 3.5 and 4%. Fed pauses. Treasury stress simmers but doesn't break. In this setup, we hold balance. 45% equity, focused on dividend strength and pricing power. Staples, utilities, mid-cap cyclicals. 30% in ultra-short bonds and rolling treasury ladders, 10% in hedges, put spreads on high beta names. VIX futures if volatility is mispriced, 10% in high convexity alternatives. Bitcoin, small-cap biotech, structured notes with defined downside.
This is the digestion scenario. It is not bullish. It is not bearish. It is where markets churn, but capital still needs a home. This is when passive gets punished and selective alpha returns.
Bear case, CPI surprises to the upside. BRICS escalates, liquidity thins. In that world, we shift defensive. 25% equity, focused only on names with strong free cash flow and low volatility. Cash rises to 50%. Optionality becomes priority number 1. 10% into long-duration treasuries. Even if rates rise, they become a parachute when panic hits. 15% in volatility hedges. UVXY. Out-of-the-money puts. Inverse ETFs with strict stop losses.
In the bear case, we do not guess bottoms. We buy time. We protect capital. And we look for stress points, credit spreads, default rates, ETF outflows before we redeploy.
Black swan. This is not trading. This is triage. 10% equity, fully hedged, 70% in cash equivalents, money market funds, T-bills, overnight sweeps, and 20% in physicals, gold, real estate, energy infrastructure. You are not playing offense here. You are buying time.
Let's talk hedges. The convex shield is not a hedge for doomsday. It is a volatility engine. It activates when the tape breaks, and it pays for itself when others are losing control. We build it when VIX is below 16, when fear is cheap, when SQQQ is ignored and UVXY is bleeding. Then we scale. Small at first. Add if RSI drops under 40. Exit when RSI exceeds 70. If the trade pays quickly, we trim. If it stalls, we exit. Discipline is the alpha.
Most investors don't fail because they take too much risk. They fail because they can't let go of old winners. They know tech is extended, but they freeze. They think one more run is coming, and that hesitation is what costs them most. I call it rebalancing denial. You know your allocation is wrong, but it made you money. So you wait, and the market never punishes you all at once. It erodes your edge, slowly, then suddenly.
That's why we trim. That's why we rotate. And that's why we keep 5 to 10% in asymmetric plays, the ones with 3x upside. High ADR, strong momentum, clean charts, not lottery tickets, strategic bets.
Cash is not weakness. It is a call option on the future. Dry powder means control. And control is the only edge when the forecast is priced in and volatility is mispriced.
This portfolio map is not about predicting the winner. It is about surviving the sequence. Base, bear, bull, swan. If you are overexposed to any one path, you are not diversified. You are vulnerable.
And when the rotation accelerates, it is already too late to adjust. The moves come fast. The liquidity vanishes. And the traders who planned ahead are the ones who get to play offense. In segment 8, we close the map. A final synthesis. What to remember, what to watch, and why the best strategy isn't a prediction, it's preparation. We built this episode for one reason, to give you an updated map. Because the breakout failed. The bull case got front run, and the only thing left to price is risk. The S&P 500 closed August 1st at 6238. The Nasdaq 100 at 22,763. Our expected value for year-end puts the S&P at 5962. The Nasdaq at 21,275. That is not pessimism. We are not calling for collapse. We are calling for recalibration. Because if the upside already played out in the second quarter, then the third and fourth will be about defending those gains.
And if you want the full scenario tables, the probabilities, the drivers, it's all live now at financefrontierai.com. August and year-end forecasts updated monthly, free to access, built for allocators. And don't forget to sign up for the 10x Edge, our weekly newsletter packed with asymmetric stocks, tactical strategies, and investor psychology that works in the real world. Only at financefrontierai.com.
And if this reversal caught you off guard, now is the time to study the tape. Go back. Rebuild your risk map. You don't survive cycles by guessing the trigger. You survive by staying flexible when the noise gets loud.
If this episode helped you think better, act faster, or protect capital, then don't keep it to yourself. Subscribe on Apple or Spotify, follow us on X, and share it with one friend who needs it. Help us reach 10,000 downloads. Help us keep this series in business. And if you missed it, go back and listen to Markets 8 The Future. That was the early warning. We showed how 6 months of upside got burned in 6 weeks. That episode broke the front-loaded risk cycle wide open.
Or if you want the full psychological setup, hit big gains in May. Payback's coming. That's where the optimism peaked, volatility hid, and capital started to hedge under the surface. You'll hear this reversal coming before it hits.
This isn't just a show. This is a macro navigation tool. Built by AI, guided by signals, focused on the intersection of volatility, psychology, and survival.
We cover finance, AI, money, and mindset across 4 series, all grouped at financefrontierai.com. And if you've got a story that fits, we may pitch it in a future episode free if there's a clear win-win. Just go to the pitch page and take a look. This podcast is for educational purposes only, not financial advice. Always do your own research and consult a licensed financial advisor.
Markets evolve, risks compound, and no forecast, no matter how strategic, guarantees future results. Manage your exposures accordingly.
Music in this episode, including Not Without the Rest by Twin Musicom, is licensed under the Creative Commons Attribution 4.0 license. Copyright Finance Frontier AI. Unauthorized reproduction is prohibited.
Stay fast, stay hedged, stay frontier.